Is it stupid to be bearish stocks? Hi, everyone. Welcome to the Real Vision Daily Briefing. With me today is Cem Karsan, founder of Kia Volatility. Hi, how are you? Welcome back.
Thanks. Great to be here. Always fun.
So I need to credit, before we even start, that opening question to Brent Donnelly, who used it as the title of his daily piece today. For those of you who get Brent's work at Spectra, you'll recognize it. But it was such a good question. I thought to myself, I'm stealing it because it's kind of what everyone's asking, right, Cem? I mean, we have a situation today where U.S. equities close the day up again in rally mode. We have the Dow. Oh, wait. We turned around.
Yeah,
Okay.
It kind of turned midday, so it was kind of a big reversal.
See, I like to check in real time. Okay, so it was in rally mode, and we'll talk about why that happened, but it was in rally mode, and we have had this sort of relentless, push higher, even though a lot of people have felt weird about it. So even better now that we've turned, is this just a momentary thing, or are people trying to sort of say, wait a minute, this thing's gone too far? What do you make of the turnaround today that we saw?
So when you have me on, it's a little different, right? I'm not going to point to a macro reason as much as a flow-based reality, right? The market is a voting machine in the short term. And the reality is that this market has run up based on structural flows up into OPEX and has really, much like it did last month and much like it did the month before, swooned, right, for a very short period. Before taking off again, into the end of month and then the first 2 weeks of the following month. That's been the trend. This is a flows-centric push that we've been seeing for quite some time. We've called for this kind of blow-off top dynamic that happens a lot of time into what's otherwise kind of a structurally bearish environment. This is, markets purposely have to squeeze shorts before there can be, reflexively before they can decline. So this has been a very, very strong move. It has changed the narrative, as price always does. It has changed positioning, and most importantly, which I think we'll get into later in the show, vol has been incredibly well supplied, which has allowed entities to take risk and natural structural flows to kind of flow back in the market in those periods of structural strength. But here we are, week period after the Fed came in, once again being a little more hawkish. I've been trying to do that for a while. The market hasn't been listening, but this time up against a much different positioning, backdrop.
Yeah.
So I think what we're seeing here is again a very important kind of level here, 45.65 in the S&P futures. Makes sense to kind of test these levels and see how things go in the next 24 hours.
Okay, so that's super interesting. And that's why you would have seen as you got up to that point today, because it was pretty strong, when we were looking, which is why we're all in this situation. It's summer, right? And heaven forbid you go turn your head and do something else. And it can turn very quickly. So it sounds like what you're saying, and we will dig into some of the meat behind that, because you do pay attention to things that aren't always on our radar, which is why we love catching up with you. It sounds like, if you've been hearing people say valuations are stretched, all this kind of stuff, it sounds like you're saying it really hasn't been a fundamentally based move this last stretch of the rally anyway, right? Is that what you're saying?
Fundamentals, there are lots of studies on this. Fundamentals are not predictive statistically for market performance in any period less than 10 years. It matters over 10 years rolling periods, right? I know that throws a big, bomb into narrative and what everybody else in the world thinks is important. They are statistically irrelevant to market performance in any period longer than 10 years. They do matter over 10 years. They do matter eventually, but the way they matter, I've given the plane analogy, right? Is that they matter when the jets stop firing on the plane, right? It's the elevation, and it's a risk management tool. And eventually, during periods of illiquidity, think about 1998, 99, we knew there was a tech bubble. NASDAQ doubled in the last 9 months before it dropped 92%. Were fundamentals important when it doubled, when the NASDAQ doubled 100%? No, but when the liquidity came out of the market, things got back to rationality. We know that now, but we watch everything day to day and week to week and month to month and, try and assign a fundamental value to it. But, NVIDIA rallying 200% in a matter of months, is that fundamentals? There's a narrative behind why it's fundamentals, but no, it's a flow-centric reality in the short, meaning month, quarter, annual, even multi-year. But over the long run, the macro realities will catch up, generally when the liquidity is no longer there, and all that matters is the put on businesses.
Wow, that's so interesting. And this is one of these moments where you have to take a step back because, a lot of people follow that narrative story, right? AI, it was gaming before, it's AI, and now Meta's up. Meta did hold up today. I just checked that. It's still up 4%. Their revenue is up 11%. And you turn on the TV today and you're hearing advertising, social media advertising is really strong. And, you always hear the fundamentals. So explain to us what's happening from a position point of view. And maybe importantly, is that changing? So what's been going on that this flow centric reality that took us to this point? And do you sense that maybe we're entering another phase now?
Yeah, so positioning was dramatically underweight early this year. Particularly in the Nasdaq, put to call ratios were dramatically heavy to put. People were speculating. Hard to imagine that, right? Because this is only back in February. Speculation was massively on the put side. We had seen a dramatic liquidation across the tech space. Commodity centric and value names have really held up. And guess what? When everybody gets on one side of the boat, what happens? You got a bunch of speculation and call buying, which was, calls were cheap relative in the AI complex. You had massive vol supply, which you continue to have, and we'll get back to that in the S&P 500 itself, pinning the market, allowing it for the broad market decline to slow. Once that took hold, the reversal, and by the way, the NVIDIA story that nobody talks about is back in last year. NVIDIA was actually a big bearish thesis for a lot of people because of what was going on in Taiwan and China and the fears related to that. That narrative was all encompassing at the time, and put speculation was dramatic in the stock, and the calls were in the price. So what happened? It caught the complex really on the wrong side, and the squeezes started. But guess what? Now it's the complete opposite, right? Now there's massive call speculation in the tech names, AI. Everybody is now on the other side of the boat, and we called actually at the beginning of this month that had gone too far. Now we had called in February that we should see a tech dramatic outperformance, and now guess what? Going into expiration, right when the vol compresses and these calls decay for dealers, you get massive stock selling from dealers. And that's what we got in the 2 weeks heading into expiration. Again, this is how these flows work. And now you're starting to see the rotation of the way. The narrative for everybody is, the bank stocks they got oversold and they need to be bought up now. The narrative is that oil is stronger now, and the commodity names should be doing better. And the Nasdaq has gone too far. But the reality is the positioning just got too far the other way. And there's structural dynamics when that happens, particularly in the vol space, that feed back into reflexively forcing back rotation. So that's kind of there's a lot more to it than that. But the thing that hasn't, so those are things that have changed. This is the world rotating around the center of the S&P in the market. And we've seen dramatic historic moves in rotation and lack of breadth. There's a lot of people have talked about that. The 7 names leading the whole rally for the longest period. The massive value growth, rotation a year and a half, 2 years ago, back to this, last 6 months, the other reversal, small cap versus large cap. All of that is rotating historically. We're seeing historic dispersion, between the index and the constituents. That continues to be the case and will continue to be the case as long as the S&P vol, the vol at the center of the market breadth, at the center of the market, it continues to be well supplied. And that is the one thing that has not changed for 2 years now. That eventually will run its course as well, but we are not there yet. And that is really a function of bigger structural flows. There's structured product issuance to dealers, massive selling of all that structural that's been coming on the market. Again, that's a function of higher interest rates, better yields to these structured products that are getting stacked above T-bill rates with higher vol, right? And look much more appealing now in a market that, where people aren't sure how markets are going to perform going forward. And that's caused a wave and massive increase in structural product issuance, which is selling vol to banks, selling vol which are selling vol to market makers, which are compressing the S&P 500 and causing a pinning of the S&P 500 relative to everything else, and massive rotations around that. So this is just a glimpse, right? But these are the things that matter under the hood and what's actually driving.
That you really have have sight into. When you're talking about structured product, for people who may not be familiar, you're talking about what, like asset-backed securities, that type of thing, mortgage-backed securities.
Yeah, I mean, in particular in the S&P 500, right? There are tons of structured products that will allow you to sell vol, whether it's this JP Morgan structured trade, which is not a structured note per se, but things like that where they're essentially selling vol to pay for locking in some type of downside protection or some type of upside limit. They can sell puts and calls, right? Sometimes.
Okay, so these are structured sort of in the options world around equities, as opposed to the sort of bond products.
They're all kinds, right? But the ones that I'm most specifically talking about are the ones tied to the S&P 500 because we're talking about equity markets specifically.
Right, and that has the function of dampening down volatility in the S&P 500.
Correct. I mean, as a basic example, imagine, you can sell a strangle, something 20% out of the money on the downside, 20% out of the money on the upside, and yield, at 1x notional to your assets, and yield maybe, 3.5% in doing that. There's other ways to do it. There are iron condors or other structures, right? We can get into all of them, but in the most basic sense, that gets stacked upon a risk-free yield of 5.5% now. That's a 9% yield. If you can get a 9% yield and then only start losing, 1% every 1% below 20% down the market or 20% up in the market, that's a very appealing, alternative for people who are less interested right now in having that equity beta exposure. Particularly having markets having run as they have, and the risk that we're seeing with higher interest rates and worse liquidity and all the fears that we have with geopolitical concerns. So, 2 years ago, you would have yielded 0% on the, or close to 1% on the T-bill, and maybe this yields 4%. That's not very appealing, right? Particularly after a 15-year, 14-year run of 15% returns on average. Why would you be out of the market? And so the risk reward of these products, ironically, as interest rates go up, are causing vol supply at the center of the complex, which is the S&P 500. And that vol supply, is a consistent force in the current window and forcing this cycle to go longer than you might expect.
And when you say cycle, you mean the run up of tech stocks or the rally of stocks in general?
The stability of markets in general, which by definition, if markets are stable, there's a natural positive bias to markets, which I can get into the structural causes of that. There's these von Charm flows I talk about. There's the natural just cost of money, the discount rate that forces arbitrage for markets to climb naturally. There's the earnings that come in from companies. There's inflationary focus. All of these drive some positive flow, right, to markets. Never mind vol targeting strategies and all the other quantitative strategies that force these flows. But a market that is pinned, think of 2017 as the proxy, where implied vol is massively pinned, naturally has an upside bias because of the positive buyback of stock and everything that happens underneath the hood. That is very much kind of where we are and have been in this market. But now at the bottom, it was paired with very, very high short interest in the market, wrong-footed relative balance in the market of supply and demand. That is not where we are now in terms of the supply and demand and Delta One kind of exposure. Vol markets are also broadly, in terms of Delta One positioning, much more unbalanced than they were at the bottom, right? They are more, I guess I should say, more balanced. They are, if anything, more aggressively long. Sentiment, positioning have all dramatically changed, really in the last 3 months in particular. And so all of that now is paving the way for potential more risk to the downside. But that vol compression is still in place, and that's the part that is going to continue to make it hard for this market to decline for some period, and will likely, and as we've argued for some time, will likely continue to lead to a squeeze higher for a bit. But the structural macro effects, which we've talked about, which matter over the long run, are withdrawing liquidity from the market. Delta One balance, the Delta One exposure is now much more balanced, if not a little bit longer than it should be relative to macro. And so the windows are in windows of weakness, these short periods, right, where there's not as much structural positive flows coming from this vol compression. We're going to see weakness like we have seen the last week or so. And this is exactly what we saw in June and May. And so these are periods to take advantage of, to look for potential greater weakness. Tomorrow is important 24-hour period where, on a Friday with low liquidity in the weekend, where there isn't strength yet. If a breakdown is going to happen, which I don't think is highly likely here, but it should really be here in the next 24 hours. If it can't happen here, you have to keep buying back into this because the vol compression is simply just going to force continued end of month, beginning of month strength, and then into the next expiration cycle here.
So I want to ask about that, sort of the conditions that are going to change, because it sounds like some of the dominoes are falling off, but you still got that core suppressing volatility, which is going to create upward pressure. A couple different people pointing out or suggesting that the sell-off today was on the news that the BOJ is going to tweak its yield curve control. I would say we've heard that before. We have a BOJ meeting tomorrow. So how do you, when you're looking at these sort of market functions and operations and the signals you're looking at from the markets you track, how do you marry that to that sort of fundamental catalyst rumor that may or may not have been the trigger? It sounds like the market was ripe for anything to turn it.
Yeah, I mean, I can't tell you the number of times the earnings have been negative, and you've had a positive move in the market where unemployment numbers have come out hot and market rallies. That CPI is seemingly bearish and the market rallies. People point to the fundamentals when they go in the same direction. The reality is they matter, but really matter in the context of flow. So when flows open windows where there's structurally potential weakness, when the probabilities, when that tinderbox is packed with potential dynamite, that's when things can actually these narratives can take hold, and reflexively, as the market declines, become a more important thing. The bank run was a problem in a window where there was weakness, right? And then there's strength, and all of a sudden, there's no bank run anymore. It doesn't really matter, right? You can argue it was the Fed coming to the rescue, et cetera. But the reality is, these markets are reflexive, and the more potential risk there is, yes, a spark like the Bank of Japan doing something along those lines can, in the right environment, cause a major kind of sell-off. But the fundamental fragility that has been put in place by a lack of flows or a change in positioning is really the core necessity for a decline to actually take place.
I think it's really important, right? It might be one part of the story, but it's not the whole story. And if you really want to understand what's going on, you need to sort of look at it through that lens. I want to get a question in from Boris, because I think it's related to this before we unpack a little bit more of what you said. And he says, I'm curious about your opinion. Do you agree that low volatility is generally followed by low volatility with regards to the VIX? And therefore, the fear of a volatility shock that some people are talking about is probably wrong.
Yeah, so this is a very important fact that people don't understand. Most people who look at volatility and they think it's mean reverting, right? And on a broader sense, it is. But if you look at the majority of vol of the VIX or the implied vol at the money a phenomenon, they're between 8-9% and 20, 25%. Within that range, which is the normal range of implied volatility, what we actually see is the opposite. That the lower vol, buying vol when it's low and selling it when it's high is actually not what works. The lower vol gets in this range historically, the more on even a risk-adjusted basis, not just in absolute terms, on a risk-adjusted basis historically, the more profitable that selling vol is. And the higher it goes into that range, the 20 to 25 range, the more positive outcomes that you see for implied volatility. That's counterintuitive. Why would you want to buy high and sell low? Why? Because reflexively, when vol is well supplied, when it is low and everybody has it, it actually itself pins the market. It actually reflexively causes less realized volatility outcomes. And when it's unpinned, when vol is at a higher level, markets are able to move more. And generally there are more reasons, right, to be concerned because that vol is higher for other reasons. And those tend to historically lead to more positive outcomes for vol, even relative to that price. So very counterintuitive, but this is reflexivity at work. This is what I'm trying to express to people. When the vol is very well supplied, Dealers are long vol. When the market goes down, they have to buy massive amounts of stock. When the market goes up, they have to sell massive amounts of stock. Markets are stable. They're well, they're well pinned, and for the most part, it becomes a losing reality of owning implied vol, because realized vol is pinned, which leads to more selling of vol, which leads to more pinning, which leads to more selling of vol. It's a hot potato until everybody is selling vol. Harken back to 2017, you get historic pinning of vol. It's all relative, right? It doesn't mean we're always going to go back down to this 9% vol that we saw in 2017, but it becomes more and more compressed until somewhere in the market there becomes a concentrated short, whether it's long-term capital management, whether it's XIV, whether a concentrated short which gets at risk. And then something happens and it's enough concentration in some area, there's too much risk taken in one area, and you get an XIV blowout, or you get a long-term capital management implosion. Macro will be the spark, as I mentioned, but the groundwork has been set. That tinderbox has been packed, right, under those environments. But it takes time, and the original portion of that, and it can take quite a number of months, if not a year or two, for these things to kind of play out. And this is part of why markets can stay irrational longer than you can stay solvent, why the fundamentals really don't matter nearly as much as the flows and the realities of positioning. But this is how the market works in the real world. And this is what the voting machine looks like. The weighing machine comes after many years.
Yeah. So where are we in that process right now, do you think? So it sounds like short term, in the very short term, even though we saw this down leg today, and maybe we'll see more weakness tomorrow, there's a setup where that's possible. It sounds like there's not all the conditions are in place for a major turn. So how do you see this playing out if we extend the lens a little bit?
The way I would, it's always a function of both, right? Let's go back to COVID, right? We knew about the COVID phenomenon late December, early January. Markets went up for almost 2 months, a month and a half, till mid-February. Vol got compressed and then eventually started going up at the end. And then we got a 30% decline in a month, right in a window where there was weakness, where the people were not as well hedged, that going into that March OPEX. Started the day after February OPEX, ended the day after March OPEX, and that decline, not a coincidence, right? This is positioning at work, and how fundamentals still matter, right? But ultimately in the context of positioning. Where are we right now? We are amidst a squeezing of the shorts. We are amidst a blow off top, a topping process. Liquidity is very weak after it's been actually relatively stable and strong on the back of both TGA drawing down, which many people have talked about, as well as on the back of all the liquidity that was provided to banks into the bank run in March. All of that supported liquidity, but now that's going the other way, right? And we know that, and the Fed continues to now has raised rates again. Two Fed meetings. Was hawkish in my opinion again here in the last meeting, relatively speaking, yesterday. And all of these things are ultimately, they do matter, and they will eventually cause a liquidation. But where are we? We're in the process of squeezing shorts. We're in the process of creating more potential energy. We're in the process of, as the market goes up, unpinning vol. And we haven't, the last piece, the dike, the Dutch boy with his thumb in the dike, with all the potential energy kind of increasing behind it, right, in the form of positioning getting worse, liquidity coming out, all of the macro things that we've talked about. That Dutch boy is S&P 500 vol. It's the offering and a supply of vol. And what hasn't happened yet is the unpinning of that vol. And so, again, it tends to take longer than you expect. We're heading down that path, checking a lot of boxes, the probabilities, that tinderbox is getting more and more packed, but it's a series of probabilities, right? And what you can't do is say, this is when, the tinderbox is packed enough, and this is when it matters. It matters more. The odds are getting worse. We're starting to see the things that we've been looking for. Have we hit it yet? I would say probably not yet, but we're getting very close. And I would say I would be very cautious here in the fall. Especially not just in general, right? I want to be very specific actively in the windows where the flows are not great, which we have been very vocal about, which we're at the very tail end of it right here for the next 24, 36 hours. There's a potential for risk here, very short window at the end of another window where things have been kind of weak. But if we can't get it, which again, it's going to take a pretty big move tomorrow to do it. We'd have to break below the 20-day, as I mentioned, in the S&P 500, tomorrow on a Friday. And if we can't do that, if we don't get a big enough news and liquidation here, it's going to be right back to the structural flows for the next, call it 3 weeks, if we can't get it going very, very soon.
So where are we likely to see what's the worst pain, the biggest pain trade? Is it those tech names? Is that where we see the crack first, or is
that's
that
where
the
it was? Pain? That's not where it is, right? And the key here is that the S&P 500 is pinned. If that's the complex, that's really things are flying around. And we had a massive, early, call it 2021. Before the market decline, right? The NASDAQ started selling off, tech started getting ugly relative to value, but the market didn't decline until later, right? Then the NASDAQ kind of declined in line. That's because positioning was not prepared for that type of a move. Then everybody got bearish, right? Everybody moved to the other side of the boat. Long put, short call, as I mentioned, very bearish on tech relative to value. The narrative of inflation, everything may be correct, but what happened is people got too heavy on the one side of the boat. And what did we see? In line with a counter trend move, and a squeezing of shorts, a massive squeezing of the shorts there, and a speculative, quick move to all call speculation and AI and all these other names, right? Meanwhile, the S&P continues to be relatively muted relative, and so we're seeing now everybody on the other side of the boat. And now we're seeing, as I mentioned just the last 2-3 weeks, a underperformance of tech. We believe that will continue here for a period, and is likely actually before the vol. The whole market starts to decline, likely to see, significant weakness relative to the rest of the market, given how much speculation has squeezed into calls on those AI and broad tech names.
So when we see this, I'm guessing that the longer it goes, the worse the turn is, or the more serious the move in the other direction. Does it sound like the entire stock market is vulnerable? Because we've had this one theory that's out there that we're kind of in a rolling recession. And so you get sectors that go down, but then come back. And then the next, this rotation that the next one will pick up the baton and everything will be okay. It sounds like you're describing a situation where there's a blow off top. There's something that breaks that is usually the final piece of the puzzle. It sounds much uglier than this sort of soft landing, rolling recession.
So what we've been trying to communicate from a macro perspective. So there's the machine, there's the day-to-day, the week-to-week, the month-to-month, even quarter-to-quarter, which is flows, right? But the bigger picture, we're talking multi-year, is not about recession, which is what everybody's talking about, right? The last 40 years is if you got whether or not we're getting a recession or not, you got the cyclical game right, you time markets well, right? The reality of what's happening now is we haven't had inflation for 40 years. During inflationary periods, you get structural decades, right, or decade plus of weakness to equity markets. I can get into why I think we've talked about it on this show before.
We have. You've been saying this for a while. You've been talking about inflation, the risk of inflation for months with us now. Yeah,
and so this is now to talk macro a little bit. We are still amidst a very sticky demand picture. That's what we've been very clear about, that this, the recession everybody's talking about is not what matters. What matters is that the economy is actually stronger than people expect because it's a demand push economy. It's been resilient to 5.25%, 5.5% of hikes, right? Inflation therefore is also stickier. And not just that, core inflation has been very sticky. Almost it's 4.8% still. It's been sticky near 5 for a year and a half, 2 years. But the reality is now all those things that were helping on the other side, first of all, year-over-year changes, right, are going to make things look worse. But oil just, is at $80 again, right? It's pushing higher numbers. Russia just, cut off Ukrainian food supplies, right? Food shipments. You're likely to get going forward, not the benefit, right, of outside of core that we've been getting, especially year over year. So, inflation has been structurally sticky. Despite what you hear in terms of, CPI was great or whatever, we're still running a core inflation of 4.8%. And that's to be clear, that's year over year increases. We're increasing prices at a core level 5% a year. Compounding, that is a massive amount of inflation relative here in the United States, something that we haven't seen, and it continues to be stickier than people realize. That is going to, we believe, and again, we're back up to this 4% level. And that's what another reason, the markets are kind of looking around saying, okay, wait a second, maybe recession isn't the problem. Maybe the fact that we don't have a recession is the problem. And we think that that 10-year and 5-year and all these other longer dated kind of yields are going to break above these most recent highs, and that itself will be a critical thing in the sense that that's when the Fed starts to lose control, because once the belief is that inflation is truly sticky and not going away, that's when inflation itself structurally begins to get worse. And we've seen this in the 70s. We've seen other periods, well documented. That's the biggest risk here in our belief. It is actually, ironically, not a recession that we should be worried about. It's the counterpiece, the fact that the economy is way stickier than people expect, that labor power is way stronger than people expect. And that's not because of cyclical reasons, it's because of structural reasons. It's deglobalization, it's populism, it's all the other things that we've talked about that are driving labor strength and deglobalization, and also a slowdown, ironically, of technological innovation, because there's less capital going to growth and less things that are deflationary that we've been seeing for 40 years.
So it sounds like we have we're almost out of time, but I'm going to steal another minute because we're about a minute late coming. And a couple different people asking, of course, can you give us your thoughts of when this blow off will happen? Do you have a date or price prediction regarding the blow off top, or are you looking for risk factors? I heard you say before that it seems to me that it's impossible to predict the date or time. You just need to see the conditions come together. But it sounds like you start to get very concerned around the fall time period. Is that fair?
I want to be clear. We actually called the 2021. The top in the market in February 2022, January 2022, almost to the day. We were 6 months out. How do we do that? Like, how are we able to kind of to put those dates out? We put dates out there, very specific kind of windows where things are aligning and the probabilities are higher. It doesn't mean it's going to happen that day. Sometimes it does, because your probabilities are higher. If you're a good baseball hitter, you hit the ball 40% of the time. That's a great batting average, right? That doesn't mean you sit out there and you hit home runs every time you get up to the bat. But we have a great understanding of these fundamental realities, and the odds are increasing. And so we are handing out certain days, right, as we go here, because the probabilities are getting higher of when you want to be very cautious and looking for to swing at that fat pitch. And those fat pitches are coming here on certain windows. So for me to sit here and just say it's going to be, call my shot and say it's that day, yeah, we'll name dates, but understand that's not a certainty of that. That's the realities of the probabilities are increasing dramatically. That tinderbox is being packed. There are some factors which are making it stickier, and we believe decreasing broadly the odds of it happening as soon as other factors might insinuate. But a lot of factors are really starting to say the odds are increasing of those realities. There are great ways to bet on this that are a little more complicated than just being long the market or short the market. And these are things that we've suggested in these windows. In 99, one of the best things to do, shorting NASDAQ, in 99 would have been a disaster, even though it eventually dropped 92%. The key was buying calls out of the money, longer dated, 3-6 months out, and shorting stock against it, delta neutral. Layering shorts and in important windows against it, being long gamma, particularly cheap gamma to the upside. This is something we've recommended, across the board for the last several months. It's worked very well. It's historically in these final months in a topping process, vol will go higher into rallies, and at least on a relative value basis, that becomes a very profitable trade and to the upside. And if you can make money on vol to the upside, right? Pretty obvious that's something that you want to have into what could be a potential major decline afterwards. So our greatest recommendation is to really be out there, being long dated calls, maybe funding them with other things that are more expensive in the distribution, if necessary, in windows. But really, when those windows come where there's a risk, which we mentioned, being actively short against them and allowing yourself to take timing and active management kind of shots against the market, which is, again, a very tough thing to do, but we've done it successfully. I've been doing this for 25 years, so in different ways. There's this is never easy. I will say that much. If shorting the market was easy, there were a lot more who aren't
brave enough to do it anymore because they've gotten killed, and the last couple of years have been tough. Just from a sentiment point of view, as you look across, does it seem like people are prepared for these probabilities at all? Like, what would you say the sentiment is around that?
Increasingly less so, right? I think every institution I talk to, our investors, other people out there are being forced into the market. The reality is these final moves up are about fear. Everybody associates fear with the downside, but the reality is at the end of a market rally, a blow off top happens reflexively because people are afraid. They're afraid of losing their jobs, or afraid of their funds going out of business. They're afraid of being underinvested, and it leads to a dramatic forced set of buying, much like forced selling happens at the end on the downside. And fear to the upside is not healthy. It leads to reflexively bigger, faster moves. This is why longer dated calls are a great add relative to stock, ironically. And it's something that that ultimately has three effects, right? Not only does it force reflexively less short positioning, so there's less ability to buy back into a rally, or there's more selling that has to happen, but it also creates just more potential energy. We're raising something higher and higher off the floor, which can then drop significantly more. And then lastly, it actually forces vol higher and unpins vol eventually. Now that unpinning of vol is a part that has not happened yet because there's structural parts that I've been talking about. And that's the part we're watching closely, that we're keeping our thumb on. If we get market up, vol up for some extended period of time, if the market starts to really kind of squeeze and sentiment continues to get more and more bullish, those, particularly in these windows we talk about, are the times you want to take that fat pitch and try and hit it out of the park.
Yeah. Great stuff, Jim. We have so many comments in saying that people really appreciate your generosity with your knowledge, because this is not a part of the market that a lot of us get a window into. So we appreciate you coming on and talking about it in a way that we can actually understand.
Life is short. It's always fun to kind of share when we can. So it's wonderful to have these conversations. Thanks for having me.
Fantastic. And we also have a lots of clamoring to have you back on the platform with maybe on one of our higher levels, so that we can really dig into this. So we are working on that, actually.
Always happy to have those conversations.
Yeah. Yep. Thank you so much. And thanks to all of you for the really great, smart questions and feedback. And chat that's happening on both platforms. It's been fantastic. Have a great weekend, everyone. We are back tomorrow with our Friday summer briefing at 1 p.m. Eastern. So be sure to join us then. In the meantime, take care and good luck out there.